you're a business owner, chances are you have experienced the dread, the sleepless nights, and those 2 a.m. panic attacks that inevitably come when we know we need to pay expenses and there isn't enough cash in the bank. In this episode, we're talking about cash flow and what you can do to improve cash flow inside of your business. Let's go. In the last week, I had conversations with over 150 business owners. And when I asked them what their biggest pain point in their business is right now, the majority said cash flow. Now, according to statistics, cash flow issues are the leading cause of business failure in South Africa, with 70 to 80% of small businesses failing within the first 5 years. In this episode, I'm sharing a few simple ways to improve cash flow in your business and 3 habits that you must start doing if you want to conquer cash flow challenges once and for all. So let's start with what cash flow actually is, because many business owners think that fixing cash flow simply means signing more clients or generating more revenue. And although increased revenue can improve cash flow, and it's definitely something you want to look at, more revenue also often comes with more expenses. So only focusing on increasing revenue won't help you if you don't understand how cash is flowing through your business or where it is leaking out faster than you're actually bringing it in. So what is cash flow? Cash flow is the flow of money into the business and the flow of money out of the business. In the simplest form, it is getting paid, actual cash, and paying expenses. Now, our businesses are in a constant cycle of investing cash and receiving cash back with the aim of making a profit. And in order for us to manage our cash flow better and avoid cash crunches, we need to understand the cycle inside of our businesses, because for every business, the flow is going to be different. So the cycle of cash flow in a business typically starts with the cash you have in the bank, right? You then deploy resources to produce or render services or products, which means that you now have an obligation to pay suppliers and team members, right? So at this point, you have either paid out the cash you have in your bank or you now owe vendors and suppliers money. No one works for free, right? In order to get cash flowing into the business, you then need to make a sale. Now, the problem is we often make the sale and it gets captured in the books, but we haven't actually gotten paid yet, which means you now have accounts receivable, money owed to you. But the cash will only hit your bank account at some date in the future. And this is the basis of the accrual system in accounting. You capture transactions when they happen, not when cash is received or paid. And only when you receive payment on those accounts will you see the cash back in your bank, hopefully with more in there than when you started out. Now, the challenge all business owners face and the solution to your cash flow problems lies in shortening this cycle as much as possible. More specifically, delaying the paying out of cash as much as possible and speeding up the flow of money into your business as much as possible while making a profit. Now, profit does not equal cash flow, right? And this brings us to a very important distinction between what you're seeing on your income statement as profit versus what you actually have in the bank, aka cash flow. Have you ever looked at your income statement and saw a nice juicy profit at the bottom of the page and then felt this surge of confusion followed by panic because that profit is not reflecting in your bank account? Like, where did it go, right? This is because there is a fundamental difference between profit and cash flow. And also because the income statement is actually only telling half of the story. So profit is not the same as cash flow. And the fundamental difference is this. Profit is revenue minus expenses. Cash flow is about the timing of money flowing in and money flowing out. That is when you got paid, actual money, right? Money coming in, and when you paid expenses, actual money going out. Now let's look at what the cash flow cycle might look like in a business that buys stock and sells it for a profit. Let's head over to the whiteboard as I explain this example to you. Okay, so the business buys stock on January 1st, right? That is when the business places the order, right? So They have 2 weeks to pay the outstanding invoice from their supplier, which means that they, in essence, pay on January the 15th, right? So that is 14 days from when they order the stock to when the money actually leaves their bank account and they pay the supplier. So they've received the stock, right? But it actually then sits on their shelf until the 1st of April when it is sold to a client. So the client places the order for the stock on the 1st of April, but they don't actually pay their account until the 31st of May, right? So this means that from the date of purchase of the inventory to the sale of the inventory, which was January 1st up until April the 1st, is actually 90 days, right? So the number of days from making the sale to actually receiving the cash, which was the 1st of April until the 31st of days, is another 60 days, right? So in this case, the total cash cycle in this business is like 5 months. And the time it takes from the money leaving the bank account up until when the money is actually coming back into the bank account is over 120 days. It's 120 days. Like that's 4 months, right? That's more than a quarter of the year that this business is actually without money. So they spent cash on January 15th, but didn't actually get it back into their bank accounts until the 31st of May. And this is where the problem comes in, because during this time, rent still had to be paid, right? Employees still had to get their monthly salaries. Water and lights had to be paid, which typically means the owner is going to need to finance those bills or expenses while they wait for the cash to come in. So they are either going to finance it through a bank or a lender, some third-party lender, or from their own savings, right? And a lot of owners actually never get out of this hole. And also, if you think in terms of like the profit, the time frame between when the supplier is paid and the client ordered the stock, if you look at the profit during that time frame, it's going to seem as though you made a profit, but the cash flow isn't going to be there because the money hasn't actually been received in your bank account. And this is a really important thing to understand as it relates to cash flow, profit, and the impact of the length of this cycle on your business. So when it comes to managing your cash flow well, your number one focus should be speeding up the inflow of money and delaying the outflow of money as much as humanly possible. So let's look at a few ways in which you can do just that. Let's start with speeding up cash inflows. Number one, ask for payment. In other words, follow up on payment. Do not assume that people got your invoice or payment request and that they are just going to pay it, right? If you send an invoice, give your client a call to confirm that they received it. And don't be afraid to ask for a date, like when is payment actually going to happen, right? Number two, stay on top of past due payments. If payments have gone past the due date, so past the 30 days or 60 days that you agreed with your client, don't just assume that, you've lost the money now and that you're never going to get it back. Get into contact with your customer. Don't be afraid to have those difficult conversations and ask them what's happening. Like, why haven't they made payment yet? And when can you expect payment? Number three, incentivize your clients and customers to pay you early. So consider a discount on outstanding payments when they are paid early. As an example, if your clients have a 30-day account, consider a percentage discount if they pay that invoice within the first 7 or 10 days. Number four, ask for deposits before the work begins and invoice progress payments or for milestones reached so that the money is coming in more regularly. And number five, as a last resort, consider getting a collections company to help you collect on the outstanding debtors. Now, I do understand that no one actually wants to get to this point where they need to bring in a third party. And ideally, you want to collect outstanding debtors before it becomes necessary for this, but it isn't always possible, right? Sometimes we have to ask for help. We actually need the big guns to get money flowing into the business again. So here are a couple of things that you just want to consider. Make sure that you do understand the collection process and that the collection company's values are aligned with yours, because when they phone or communicate with your client, they are representing you. And even though nobody likes getting to this point, it is actually possible to do this, to have these conversations, to collect the money in a way that is respectful and professional and aligned with your values. The other thing to consider is that these companies take a fee for collecting the debt on your behalf, right? So make sure that you know what those costs are and that it is actually worth the effort. So let's look at how you can slow down cash outflows from the business. Number one, pay your bills as late as possible. That doesn't mean that you need to become a horrible debtor for your suppliers. You just want to make sure that you're actually paying on the last day that the bill is due, right? So don't pay invoices simply because you received them and you actually have cash in the bank. Make sure that you understand the terms and when the last day for payment is. So in other words, if you have an agreement with your supplier to pay them in 7 days, pay on day 7. If you have 30 days to pay your account, pay on day 30. Number two, where possible, set up 30 or 60-day accounts with your suppliers. And for larger supplier payments, ask if a payment plan can be arranged. Number three, instead of buying expensive equipment outright, consider renting or leasing it. It might be more expensive in the long run, but it's always worth considering the cost of not having the cash in your bank. And also the fact that assets depreciate. There's a lot of things to consider. So speak to your accountant if you're unsure about this. Number four, if your business holds stock, this is one place where we can easily overspend in an attempt to save on things like delivery fees or price increases. So you want to make sure that you are buying stock when you actually need it and getting those stock items off of the shelf as fast as possible. And number five, just because you have cash in the bank and bills can be paid doesn't mean that you have cash to spend now, right? So be very mindful before spending cash in the bank. Always keep your monthly expenses as lean as possible. It's easy to focus on cutting expenses when cash is tight because that's the focus, right? But it's even more important to keep expenses to a minimum, even when things are actually going really well and you can afford that expense. Because the months where it rains cash is actually giving you an opportunity to create a buffer of cash for those winter months that we know inevitably will come. Let's look at the 3 habits every business owner should focus on and what most never do that will improve the cash flow inside of your business. Number 1, focus on marketing. You are not just a business owner, you are also a marketer. And most business owners are spending the majority of their time doing inside the business and very little or no time marketing the business. You absolutely want to serve your clients well and focus on ways to get your current clients to spend more, because it's cheaper to get an existing client to spend again than it is to get a new customer. That being said, you should also focus on getting new customers or clients for your business, right? Number 2, build a cash buffer inside of your business. Ideally, you want a 3 months buffer of expenses saved up. And this is by no means an easy feat, right? It's hard to save even 1 month's salary or wages, but creating a buffer isn't something that needs to happen overnight. You can build your way to it. The first shift that needs to happen is your mindset around the money inside of your business. Your business's money isn't your money. You are actually the custodian or the steward of that money. So determine what amount you want to have as a cash buffer inside of your business. Like I said, 3 months of expenses is a great goal to have. And then start putting away 1% of your revenue into a high yield savings account and adjust that percentage to 1.5% and then 2% every quarter. But commit to not using that cash buffer, right? Unless it is a true emergency. A little bit of a side note. Decide in advance what an emergency is so that it is clear when you can actually dig into that reserve and when not. When we have a cash buffer, the business can actually cover expenses and continue serving clients even on the slow or low income months. When we know that we have cash in the bank for the rainy days, it actually brings a lot of relief. And there are a lot of creative ways to manage your cash better, but it truly starts with your mindset and understanding the flow of money inside of your business. Number 3, understand the numbers on your financial statements. Now, in this case, the income statement, the balance sheet, and the cash flow statement. Sit down with your accountant and do a cash flow projection. It isn't an easy task for all types of businesses, but a task you should do regardless. Remember, it is your responsibility to understand the numbers inside of your business. If there is something you don't understand, ask, do research, find the answer. It may be super uncomfortable in the beginning, but well worth it. I always suggest to my clients that they have a monthly money date with their business and their accountant to look and talk about the numbers inside of the business. So make it your mission to understand the numbers inside of your business and your financial statements so that you can actually ask better questions and make better decisions. I hope this episode has given you some insight into managing the cash in your business better. If you found this episode helpful, share it with a friend in business and let's help each other grow. I'll see you next week.